All right, good afternoon and welcome to today's webinar on partnering with bankers. This is the first in the series of virtual study groups, virtual meetings, I should say, of the Caribbean Fall Leadership Study Group. We're going to get started in just a couple of minutes. I'm going to allow some folks to file in here. In the meantime, I'm going to cover a couple of quick points. For those of you out in the audience, you have a couple of ways to interact with us today, and I hope you do choose to do that. One is by clicking the Raise Your Hand button, which will be at the bottom of your screen. That'll allow you to join us on the screen here, either using just audio if you prefer, or video as well if you're able to do that. That's really the best way for you to jump in, ask a question, or share an aspect of your experience with the group. If you would prefer, you can also send us questions and comments using the chat function.
Okay.
Again, welcome, and we'll get started in just another minute.
Base more in.
Stool. Go in. Your hands. That's as far as it will go. Are you on?
Yeah. Mm-hmm.
Okay. How does the light look?
It makes it hard for me to read the screen.
Otherwise, you're in the dark.
It's probably better. Okay. Mm-hmm.
I can turn it down a little.
Tim, can you hear me?
Yes, I can.
All right, great.
Great, yeah, welcome, Tom. All right, and welcome to Ken as well. All right, I'm gonna go ahead and get us started. Once again, welcome to this afternoon's webinar on partnering with bankers. This is the first in the series of virtual meetings of the Caribbean Fall Leadership Study Group. My name is Tim Carer. I'm with Caribbean Research and Consulting. We're pleased to be hosting today's event. By now, we're all old pros, I think, at these Zoom events, these virtual events. I know that it's been a challenge for us at times converting the events we used to hold in an in-person setting and achieve the same quality of conversation and discussion in a virtual setting. That's why I'm going to kind of lead off today by asking all of you that have joined us in the audience today to please jump in and share your experience and ask questions of myself, the other members of the Caribbean team, and of course these folks that are on screen right now. We hold all of these events for the benefit of you in the audience, and you're going to get more out of this if you jump in. So please do. We, of course, couldn't be holding today's event without the support of our sponsors. They are Asset Map, in InvestNet Money Guide, Pacific Life, and the Standard. Thank you to all of you. We would also like to thank our friends at Salmons for helping to make today's event possible. As I mentioned, getting the conversation going in a kind of a virtual setting can be tough. We've pulled together a few people. We've asked them to be on the screen today to help get things started. But as I will at several points over the course of today's event. I'm going to go ahead and stop sharing my screen because I think it's nicer to be able to see everyone at the same time. And now just to do a quick around the table introduction. We have with us on your screen today H. Adam Holt from Asset Map, Michael Malone from Comerica Securities, excuse me, Will Gilfillan from InvestNet Money Guide, Harold Robertson from First Horizon Advisors, Michael Mirabali from Huntington, Lee Bennett from Pacific Life, Mark McGilvery, sorry, I'm going to have to talk to you afterwards and figure out how to actually pronounce your name, from The Standard, and Tom Mudlaff from United Wealth Management and Brokerage Services. We have a couple of other members of the Caribbean team with us today, our principals, Peter Beelan and Ken Kerrer. Once again, to all of you in the audience, please jump in today, either by clicking the raise hand button at the bottom of your screen or by sending us a chat. With that, I'm going to turn it over to Peter to help to kick us off today. Peter.
Okay, great. Thank you, Tim. Hello, everyone. Thanks for joining in today. Just to echo one key point of what Tim said, we're going to really use the benefit of this virtual meeting in the sense that in the past, we would have our study groups and have attendance of 18 to 20 financial institutions represented. And it was fantastic being in person with all those individuals. However, it was a limited number of people that could be part of that group. So here we are today in a setting that allows us to have 50 people to benefit from this knowledge and this sharing and this information. So in that sense, really having a meeting in this format is allowing everyone to share their information much more broadly and do it quicker and easier than we were able to do it in person. So with that, I really encourage you to take advantage of being part of this meeting because now that we don't have to be physical for it, we can be virtual and you can participate just as much as anyone that's on the screen. So please, raise your hand for questions virtually, use the chat function, send an email, do something, but please be involved because this is a roundtable of 50 people today. There's 10, 11 on the screen, but it's a roundtable of 50 people that we now have the technology and utilize this technology to take advantage of that. So that's just my, my plea to you all to fully utilize this group on screen and the rest of our collective knowledge. Okay, so with that, what is this meeting really all about? What are we trying to accomplish? And if you look at the inherent advantage of our business, all the years that we've been in this, it's that we're part of a financial institution. And that financial institution has a great brand in the market, and they have branches, and they have resources, and all these other things. But one of the key points is what they've always had is this referral network and partnering to bring clients to our investment advisors. I mean, that's what, when we've marketed to hire new advisors and, our compensation plan takes that into consideration. I mean, that's one of the inherent advantages of this industry, this business, and all of our firms. But the way we utilize that inherent advantage changes over time. I mean, we all recall when, like licensed bankers became popular, and Bank One put one in every branch, in 1990. I mean, that was right at that time. They did a great job, Bank One and others, but they did a great job of really starting that trend and growing that licensed banker role for every branch with their potted palms around that area, back in that day. And now it's evolved since then to some different, some have kept the same, some have changed it, some have changed it dramatically. But it's evolved to where we've got to figure out now how to utilize the branch, whatever that may be, or the referring employees within the bank, whomever that may be, to the best of the advantage that the financial institution brings. And that's what we want to talk about today is what are we trying what's worked, what hasn't worked, but how do we use this inherent advantage that the financial institution brings to its fullest extent in today's environment with the way the branches are configured, the way the employees' roles are, the way it all fits together. How do we do that? And the folks on screen are going to share some ideas of what they've done, but we'd also like others to share, because it's truly an evolving environment for that. It's truly an evolving environment, probably more now than ever. So if we can try and take away today some ideas of how to best leverage this advantage that fits today's workplace, today's employee roles, today's what the advisor can do. If we can do that, then we got out of this 90-minute call exactly what we would hope to achieve. So please keep those thoughts in mind as we go through some different parts of the business. And again, share thoughts and ideas. And this is a great way for 50 people that really are trying to drive their business the right direction to get some ideas and utilize. Okay. All right. So very good. So with that, I think we're going to move to some information to set the stage on the licensed banker program role, which is that more traditional one that still some firms are successfully deploying here today. So Ken, you'll go over some data for us there.
I think I'll actually take
okay.
the lead on that one, Peter. Yeah. So as we frequently do, right? We want to seed the conversation with some data. The data I'm going to be sharing today was collected via our annual benchmarking surveys, which we asked firms to complete in the second quarter of this year. You'll notice the number of financial institutions covered in each section of what I'll talk about varies a little bit, and that's because they come from 3 different sections of the survey, right? We had a section on platform program, we had a section on premier bankers, and we had a section on private bankers. A varying number of our participants filled out each one of those surveys, so that's why the numbers may shift a little bit here on you. In this case, 62 banks and credit unions filled out the section on platform program. Of those 62, 45% had licensed or registered branch staff. They were fairly evenly divided between being a referral-only model, so the licensed staff do not sell. The other half ask that their licensed bankers do sell product as well as refer. As Peter mentioned, there was a time when putting a licensed banker in every staff, a licensed banker in every branch was a common model. We've moved a long ways away from that. The new model in use in most financial institutions is to put one licensed banker in every other branch, more or less, and only 16% of the firms that we surveyed put a licensed person in every branch. Now, why the decline in the use of licensed platform bankers? One of the motivations underlying the use of this model is that it's supposed to drive greater referrals to your reps. And the data today, the most recent data that we have available, doesn't suggest that platform programs are necessarily driving that. The household referral penetration in firms with licensed branch staff was the same as those without licensed branch staff, 1.2% in either case. So, it could be that, financial institutions are looking at that data and they think that this model isn't working, and so they're removing licensed branch staff. Another, one argument against licensing branch staff that used to be a pretty potent one is that your licensed branch staff would cannibalize the production of your advisors in the branches. That used to be true, but again, based on the most recent data we have available, that doesn't appear to be the case anymore. Firms with licensed branch staff had average advisor production that was about 20% higher than firms without licensed branch staff. Now, what impact does licensing branch staff have on the institution's penetration of its opportunity? We have a couple of different ways to look at that. One is the revenue produced by the program, right, relative to the size of the opportunity. We use self-reported consumer deposits in the bank as the yardstick to measure that opportunity. We've been studying this stuff for a while, as you can see, based on the data that we have on the screen now. Way back in 1999, banks and credit unions with licensed branch staff did a better job of penetrating their opportunity than those without, based on revenue per million in deposits. You can see, moving ahead to 2011, firms with licensed branch staff were doing even better. That margin had grown a little bit. You can see that today, the advantage enjoyed by those with licensed branch staff has slimmed somewhat, but is still there. Those firms have achieved 2 to 3% deeper revenue penetration compared to those without licensed branch staff. It also used to be the case that institutions with a platform program had better profit penetration. That was partly due to the fact that selling through platform bankers was had a lower cost than selling through a rep. This seems to have changed over the course over the last 20 years. Today, financial institutions with licensed branch staff have lower profit penetration than those without. Ken, I think you were going to take it over.
Just to ask the group, gee, this is a substantial change. Those of you sitting around the table and out there in cyberspace, why did this happen?
I think one of the comments that I would make is that because we actually went from a licensed program to a non-licensed program, and I think what has happened is we've actually learned a little bit better how to get more referrals, how to be more effective working within it without licensed people. I do think that there was some competition, but I don't think it was necessarily cannibalizing. I think what was happening, at least in our system, was we had some people that were doing transactions that were not really transactions they were supposed to do. And I think they were also, they saw the incentive as being more aligned with them doing more business. And so I think that that's actually improved through this period. And then I think just simply the fact that so many firms, now you're starting to see more firms going to the non-licensed program. There's just more opportunities for, people to kind of figure out what's going on. I mean, when we first transitioned, we saw a huge drop off in our referrals. And then now we're actually exceeding what our referrals were before. So it's been a pretty significant shift in the last, so we eliminated the licensed people almost 4 years ago, roughly 4 years. So, and that's changed dramatically.
Yeah, and Mike Mirabali, Huntington, back before your time, back in the 90s, was another one of the poster children for licensed banker programs, and you're not anymore. What's your sense of what happened in investment services over the last decade?
Yeah, I mean, I certainly have seen the change, and we moved a couple of years ago. We moved from a sell refer model to a refer only model. We certainly have, and we've reduced the number of colleagues that we have licensed. We went from somewhere near, I'd say, somewhere near, sorry about that, somewhere near 750, 800 licensed bankers down to about 500, 550, but they're the most productive. Like, you know, we put some standards in place. We wouldn't hold your registration unless you're meeting certain minimum referral requirements. So I see it as evolving. I don't see us getting away from it. I know that the industry vacillates between wanting to add them and get rid of them. Now I think the trend is more towards get rid of them. But I see it, especially as you develop a mass affluent strategy, having a greater focus on the licensed banking professional is really important, because they're the ones who are quarterbacking the relationship, and then bringing the financial advisor in when you start really getting to some of the deep planning needs of the client, then the relationship emphasis changes and shifts more towards the advisor. But in terms of the introduction and really taking a client who is very limited in terms of its product set to expanding, really is instigated, I think, by the banker. And being licensed, I think, opens up more opportunity for them to have deeper conversations with clients. So I wouldn't say we're in the camp of abandoning it, Ken. I'd say we're still committed to it, but I do see it as continuing to evolve.
Yeah. How about the shift that we've seen over these last few years from commission-based product mix to a more managed-based product mix? Do you guys all feel that that has had an impact on that, immediate referral, that immediate solution that the licensed banker provides, to where it's a longer process and a different revenue stream and a different process that the advisor now needs to provide in order to sell that managed business? Do you think that's an impact?
Yeah, Peter, this is Lee Bennett with Pacific Life. I was actually going to bring that up. There's probably a pretty strong correlation in interest rates and revenue per dollar in 1999 versus 2020.
Yeah.
And I think when I was talking about the product mix, that's really what I was referring to, is the fee-based versus, annuities or different products that they were able to sell. And so we were seeing some sales of products that were not really the direction we were wanting to go. And so that's the other thing we've seen. So we've seen a big pickup in fee-based business since we transitioned over.
Mm-hmm.
So, Peter, we just recently went through and delicensed our bankers with Reg BI. We didn't really feel good about having the sixes because they tended just to sell fixed annuities or really just fixed annuities. So we delicensed them all. But Michael Malone, how are you compensating your bankers then if they're not licensed? How do you give them a referral fee or something?
It's just a straight referral fee. I think it's $35 for referral. And then we do have a higher referral fee for insurance referrals. But what's actually happened is when we transitioned over from a compensation perspective, they wouldn't let us go over that. That was essentially, I can't remember what the incentive comp group came up with, but that was the maximum we were able to pay them. So we paid them. We actually originally proposed $50 per referral, but it ended up being $35 per referral. And it's actually, in a lot of ways, that knowing they're going to get the referral credit seems like it's more of a motivational for more of a motivation for a lot of the bankers for some reason, even though they could make more on the actual commission before.
Okay.
Looking at this over the last couple of decades, it does seem like in the 90s and subsequent years that licensed bankers were essentially helping firms provide better coverage. And then what happened in the interim was that banks began adding more advisors and improving their coverage with advisors as opposed to branch staff. And think that's one of the reasons why the tide of revenue penetration shifted to the firms who were actually providing more advisors relative to their size. But the last couple of years, as you know, that stalled. We now see that, if anything, coverage is thinning out again as firms have not been able to add to their advisor pool. So it may suggest again why there is some interest again in maybe going back to some kind of a banker model. But that might be a good segue to look at what other banker models there are. Tim, why don't we look at the next one? We want to look at the premier bankers.
Sure thing. There we go. Yeah, so this comes from sort of the next section of the survey, if you will. We had 44 financial institutions fill out this section, and only 6 of them reported partnering advisors with premier bankers. Now, premier bankers are a little different than the platform bankers we were just talking about. They typically have their own book of business, are responsible for deepening the relationships in those books. But you know, this model does not appear to be very prevalent, right? Again, only 6 of 44 firms reported doing this. In terms of what asset segment the premier bankers tend to serve, you'll see that half, we've actually listed here rather than the share of firms as a percentage in these charts. We've just listed the raw number of firms because there are only 6 of them. It's easy to keep track. So 3 of the 6 told us that the premier bankers focus on clients with household assets between $250,000 and $1 million. One other firm put that range at $250,000 to $3 million in household assets. Between those, those 4, the 4 of the 6 are really focused on kind of what's traditionally referred to as the mass affluent segment. One firm in the survey used a similar range with just sort of a higher threshold at the bottom, 500,000 to 3 million, and then one other firm seems to be kind of focused maybe on that upper slice of the mass affluent, only 1 million to 3 million in household assets. In terms of how the premier bankers are registered, one of the 6 does not register its premier bankers. 2 of the 6 told us that some of their premier bankers have both the Series 7 as well as the licensing needed to sell advisory products. In one case, all of the premier bankers are registered to sell managed money. And then the final 2 told us that some of the premier bankers have Series 7 licenses, but are not registered to sell managed money. In terms of how the premier banker model kind of sits within the overall business of the institution, in all 6 cases that we looked at, it appears to really be managed as a separate sales channel. The compensation of the premier bankers is not tied to the success of the advisors that they're paired with. Premier bankers are registered to receive compensation for the referrals that they make, but only one of the 6 firms asks their premier bankers to sell in investment products. There's very little overlap among the 6 firms here in terms of the ratio of bankers to financial advisors. They all kind of exist somewhere along the spectrum of one advisor supporting 1 or 2 bankers versus a few bankers supporting versus bankers that support a few advisors. We've listed sort of all 6 here for you to see. But the real key here is that there isn't much overlap. There isn't much of a trend here among these 6.
Mm-hmm. So of the firms that have a premier banker or have experimented with a premier banker, maybe the panel could share, their impressions on how that's worked and what the uniquenesses are there versus the licensed banker program that we just spoke to.
Peter, I'll start. It's Mike. We started about a year and a half ago. We started a mass affluent banker strategy. We call them dedicated relationship bankers, and we've started small and we've expanded it slowly. We have 45 right now in our branch system, and we've identified a potential of about 178 branches that could be covered by a dedicated relationship banker. So you can call us about a fourth or so covered. What we found is there's a lot of success in deepening, particularly on the deposit and lending side. Investments was marginally better, surprisingly, only marginally better than what we would see with licensed bankers that are not, massive targeted to mass affluent. But we're starting to see that really shift really over the last four months or so, where we're starting to see significantly higher volume of investment referrals. And I think part of it was initially just because of the environment we were in. We had a little higher spread on deposits. Banks were starved for deposits. And so there was, I think, a little bit more of an appetite. Now that's completely, upended. And candidly, investments are the king in terms of help, along with mortgages, right? In terms of helping banks, branches hit their scorecard goals. I would say the benefit of and the real difference that I've seen is, and you alluded to it earlier, Tim, is that they have their own book of business. We assign 1,000 customers to that banker, and their job is to penetrate and deepen that book of business. It takes them out of the mix of a lot of the typical service that they would have on the platform, so they can focus on outbound calls and partnering with their business banker, mortgage banker, financial advisor. So I think that clarity and focus on sales really helps drive results from that group, and we've seen really good results out of our group.
Yeah, sounds like it. Well, in some ways, this is a newer role I've found. I mean, there's been private banker role out there. Firms go back and forth from having it to not having it, but this in-between role seems to be a little bit newer. And quite honestly, it's taking the lead from a lot of what we do in our industry, which is actually having assigned clients. Instead of that branch just, catching everyone that comes in, it actually has these assigned clients and relationships, which then can provide maybe a more likely referral than the 30 or 40% that used to refer from a licensed banker role in a given month. There's maybe a higher likelihood that you all have seen of getting these folks engaged, because it is part of their job versus one more thing that a licensed branch employee has to do. So that might be part of what is added to that support.
Do you kind of assess a premier banker then by the profitability of that book of customers that it has? Is that the core measure that you look at?
Well, compensation, it isn't necessarily commission for many of them. It is more asset-based. So I think it is more the outstandings from the loans and the deposits and investment dollars. Many ways, this is a mirroring of what Merrill Edge program is. It's a little bit different dollar household that the Merrill Edge clients work with than what this Premier Banker works with, but it's a very similar responsibility, let's say, in that they're up to 3,000 Merrill Edge advisors that are in bank branches. And, that's all about partnering the loans and deposits with investments, as Mike said. Well, that's essentially what this Premier Banker role is meant to do. It just refers the investments, but it's still all about gathering that relationship of those clients, that have more wealth than the typical branch client, but maybe not enough for private banking, or but they're valuable clients. So I think it mirrors that approach to a great degree, maybe with a little bit different responsibility within the roles, but the same concept.
It does seem to fit naturally with an institution that wants a mass affluent strategy.
Hey, Peter, this is Adam. Can you hear me?
Yes. Yeah, Adam.
Hi, everybody. Adam Holt, Asset Map. Thanks for being here. The question I'm curious about, whether people are experiencing, what's that process for the Premier Banker? I mean, when you think about how much is happening for consumers in leading with advice, right? This great demand for financial planning. And I know Will and his team at InvestNet and Money Guide are focusing a lot on this. I'm really curious whether you guys are seeing at the bank level, or whether your research looked into it, whether the demand for advice is starting to affect the Premier and, of course, the private level banker. If you guys have any research or insight on the process that's drawing people in to start talking about investment and or insurance and or annuity.
Mm-hmm.
So just kind of,
yeah, who wants to? Okay.
Yeah, I mean, just to speak from kind of a high level, right? So we know that for your typical bank or credit union, right, very few of the bank's customers or the credit union's members consider, or those of them who have a financial advisor, very few of them consider someone in a bank or in a credit union to be their primary financial advisor. And we've looked at this over a few years now, and there are almost as many bank customers today that consider a private banker or a bank officer to be their primary advisor as they consider an advisor working for a bank to be their primary advisor. So I think that goes kind of exactly to your question.
Yeah, Adam, I would say that this is an area that the banks still have room to improve upon. Banks view so many things through the product lens versus the advice lens. And, and that's where our business tends to really add in the relationship, is that, our advisors as an industry are providing advice to the bank clients where, many of the products and services that they buy from the bank branch, there isn't that same level of advice that comes along with it. It's advice on how the product works. Here's how this checking account works. Here's how this HELOC works. But there isn't this comprehensive advice on when you should get the HELOC. And there isn't this comprehensive advice of how it impacts your taxes, or how it impacts your estate planning, or how it impacts all the other parts. And that's where I feel, that's the advantage that we really offer these bank clients, is that we're offering advice versus just product knowledge. So I think banks do a tremendous job on product distribution, but I don't think they offer enough advice to that typical consumer client, which is what we do. And I think the question to tie it back to all this is, how do we partner with the right role to be able to offer that advice to clients? How do we offer the right, recommendations, investment advice to get in front of the people that really need it? Because, our research still shows us that we're gathering a relatively small percentage of wallet share of investment dollars of our bank clients. And, I think it's 8 or 10%, let's say, of the clients that are at the bank. That's how much investment wallet share we have. So, just that product approach hasn't brought in all of their investment assets. So we've got to take this broader approach and do a better job of getting out there and, showing what we have, because 90% of those investment dollars, those clients bank with us, but they still don't invest with us.
I think banks are doing a better job with this mass affluent segment, however. Research that FISA will soon be publishing, BISA will soon be publishing, indicates that for the mass affluent segment, the penetration is really 21% of assets. Much better, but still way less than half, right? But I think that going back to Adam's point, question is, what is the process? How does this banker, who's primarily focused on bringing in deposits and selling credit products, what's the process by which they turn the corner toward broader advice, and to what extent is it knowing when to hand off to an advisor, or is it becoming more holistic themselves in terms of, like, for example, I don't know, but are these premier bankers expected to do planning, and shouldn't they be expected to do planning? Will, you have any experience with that?
Yeah, so our perspective on this, Ken, and everyone on the call, is it comes down, a lot of it, to wanting to provide an advice relationship with anybody who walks in the branch who has something that needs, that they need help with. Whether you provide comprehensive financial planning advice is going to be contingent on what they need and who they are. And you can't determine those things unless you find out about them, right? So a comprehensive financial planning relationship may be something that eventually makes sense between the bank, the advisor, and that customer. But before you get there, you've got to do that data gathering. So tools certainly come into play here. So like Asset Map, for example, is a great tool that you would want to use to help those bankers or just the firm as a whole reach out and gather this type of information. So whether you use that or Money Guide, and we do of course have configurations that are specifically made for the licensed bankers of premier bankers. But if you use both of those tools, you're going to learn a great deal about who those people are and what they need. And even Money Guide blocks allow for really the customer to say specifically, I have a need today for this particular product or solution. So if it ends up being a product conversation, and a lot of times it will be, because that's why people are still going into the banks to talk to a banker, that's a good thing. You're helping them with what they need today. But by learning more about them in that process and having a prescriptive method using technology for that banker to take it to the next step. This is where you can say, hey, we discovered today that you needed additional help with insurance or an income product. But based on what we've talked about, here are some other things that I can help with. And they can literally, like as a hybridized model, they can sit there with the technology together and do that discovery. And we think, the planning process, if you're talking about the comprehensive one that is the most beneficial for everybody, that will come with time when it's proper to engage in it. But we don't need to try and force it immediately for customers who do need a product solution today. So again, it's just about putting that technology out there, gathering the data, offering choices, and then of course, using the technology to be able to promote it to the person who's going to make it the most impactful in the long run.
So Mike or anyone else out there in cyberspace who has a premier program, I know BMO's on the line, and a legacy credit union, Northwest Financial, we're all on the, we hope they've all registered. If they're on the line, do premier bankers actually have access to training in using financial planning tools, or a tool, a data organizing tool like Asset Map?
I'll start, Ken. We do. We give them access to Money Guide Pro. There's what was called Starter before. It's essentially, we call it the retirement roadmap. So give them because 80%, everybody has a retirement goal, right? And probably a good number, if you were to name top goal, that probably would be 70% of the cases would be the first thing somebody would come to mind. So we gave them the training, gave them access to the retirement roadmap. And the utilization's been spotty, to just be candid about it. It's really challenging for them to get into that conversation and have that that deeper level of discovery. They've developed some in-house tools with the bank that they call it their financial health quiz, that allows them to start gathering information that could lead to deeper discussions and potential other opportunities to be able to serve them. But it is a challenge to get adoption of planning tools with bankers, because it's a different mindset. So we're trying different ways to be able to introduce those conversations to them. Whether and we've included them in some training that we're providing our advisors in terms of client relationship management and being, kind of naturally curious and asking the right questions. But it is not, it's not a flip the switch by any means. I think it takes probably to get a banker comfortable, it probably takes a good 6 to 12 months to get them to a point where you feel like, they understand how to veer away from the product focus and be a little bit more focused on just learning more about the customer.
Mm-hmm.
Yeah, that's a great point. I have to say, Mike, we experience this all the time. The transition from what I would say banker to full-fledged financial advisor guidance is almost a non-starter from our experience. There is a discerning difference between moving from a banker to a financial advocate, somebody who literally is your trusted resource, who can be promoted to someone was viewed actually beyond what Peter mentioned as simply, let's say, the banker where I have my assets. And I think what's really critical for all the banks and participants listening is you have to find ways that are going to be approachable, that clearly gives, I think, a reward of what's in it for the consumer to reveal some of this data, because I can get maybe some financial health indications back really fast, right? Can you tell me just by meeting me, instead of showing me my bank accounts I have with you that may be under, maybe better rates, maybe better line of credits, better product, can I show you what other peers have done? I mean, I think about it like Amazon, right? We've all used Amazon. And every time I go on Amazon, it says, I want to buy something. I know what I want. I go in there to buy a specific solution. And it tells me 5 other things that my friends bought that I should probably buy too. And I buy 2 of them, right? Just because it looks like a good deal. I wasn't thinking of it. Or Netflix shows me what movies that I could also binge watch and lose my entire night on watching this stuff. And they're kind of right. And I think we need to get to a place, one of the things we've been experimenting with at AssetMap is actually showing you what other peers have. You came in to talk about banks, but by the way, they also have this life insurance. Have you thought about that? They also have annuities. Have you thought about that? So my point in saying this is really all of us to try to, and I'm curious what other people are doing, is how do we get clients engaged to start thinking that I can actually have an advocacy relationship as opposed to an execution relationship?
Mm-hmm. And that would seem to be the kind of toolkit that a premier banker should have, because they are supposed to develop that relationship, right?
We've had a number of questions come across around sort of how, what's the basis upon which you qualify the referral, and thank you to Mike Malone for jumping in over chat and providing some detail there. I thought that this response from Tom Baldwin is pretty interesting. I believe that he's talking about licensed bankers in this case rather than platform, but the basis they use to qualify the referral is pretty complicated. So we only qualify if the member has 3 to 6 months living expenses in reserves, has any amount to invest beyond that, and generally doesn't need the money for 3 to 5 years. So to me, it sounds like to gather that, to get your tick for the referral, requires you to begin to have some sort of holistic conversation with the client, right? How much money do you have now? Do you have more than you need to survive on? And when are you going to need the money, that you have available to put into savings or put into the market? I thought that was kind of an interesting way maybe to guide that conversation in a more holistic direction.
I have some more questions about registering premier bankers and so on, but they're going to be similar to the questions we might address with private bankers. So Tim, why don't you show us what we've learned as an overview of the status of private banking partnerships.
Sure. Let me pull up my screen again. I hope everybody can see it. So yeah, in this case, 44 banks and credit unions filled out this section of the survey, and a quarter of them reported partnering advisors with private bankers. In terms of the asset segment that the private bankers focus on, you're definitely looking at a kind of more of a high net worth group here versus the mass affluent focus that we saw among the premier bankers. But there is some overlap, right? So more than a third of the firms that have private bankers say that their private bankers serve clients with household assets between 1 million and 3 million, right? So that is very much the same kind of the same thresholds that we saw in use among the premier bankers, but half of these are focused on households with more assets. 18% said more than 3 million, 27% said 1 to 5 million. And then there were a handful of these firms that told us that their private bankers focus on serving clients with household assets of less than 1 million. So that certainly kind of an outlier here. In terms of how the private bankers are registered, 1/5 of the financial institutions in this group said that they don't register their private bankers. Another 30% told us that some private bankers are registered to sell managed money. Likewise, 20% told us that some are registered, have both a Series 7 license and are also registered to sell managed money. Very few told us, only 10% in each case, that all of their private bankers are Series 7 licensed, or that all are licensed to sell managed money. So, on both sides of your screen now, you're seeing there's sort of a different approach among these private bankers than we saw among the premier bankers. One thing that we've seen change over the decades, certainly, is that private bankers really no longer act as fiduciaries. Most of the ones that we studied are primarily high net worth lenders. In terms of how they're compensated for making referrals to financial advisors, as we saw with premier bankers, generally speaking, the private banker isn't compensated based on the performance of the advisor that they're paired with. Only 20% of the firms that we studied include advisor performance in the private banker's scorecard. But in all cases, or sorry, I should say in all but one case, or sorry, yes, in all cases, the private bankers are registered to receive compensation for the referral, but only one firm that we studied expects their private bankers to sell brokerage products. In terms of the ratio of private bankers to financial advisors, the most common model is for one advisor to work with 2 or 3 private bankers. One firm that we studied has a 1-to-1 ratio in, again, in how they partner the advisor with the private banker. In 2 firms, bankers work with 1 or 2 advisors, but at the other extreme, in one case, one banker supports all 11 of the firm's advisors.
So we notice both with private bankers and premier bankers that they're not really working as a team if their compensation isn't intertwined. There are clearly barriers to that if you're not going to register them. But I wonder what you all who have private banking programs or are thinking of partnering with private bankers think of that, and how you would solve that problem of aligning the compensation of the banker and the broker to work together to serve the client.
Yeah, so I have a comment about that, and I don't have a solution, but I am curious to see what everybody else says. One of the issues that I have currently, both with Premier, we don't have the same structures you're talking about on Premier, and we really just started it, so I don't have a lot to comment on that. But the big thing that I would comment about is that inconsistency of licensing and inconsistency of compensation is a huge problem, because it's really difficult to do 2 things. One, to create a compensation program that's consistent. And even things like if you have a referral program and you have to provide certain information if there's a referral payment, it's trying to, from a compliance perspective, to follow that and to make sure that people are doing what they're supposed to do. And then finally, the training, because you know, when you go in and you start training people, you're training some people that are licensed to interface with the client in a certain way, but then you've got other ones that aren't. And so I think it's an issue where, and I'm curious, because I know Michael had said that he has some are licensed, some aren't. I'm just curious as to if anybody has any comments about that issue around inconsistency of licensing.
I mean, I'll just say something on license. I'm sorry, Harold, you go ahead, Harold.
No, okay. I was just going to say, at First Horizon, we have most of our private bankers are licensed. We've grandfathered some of the older ones that just don't want to take it. But they have to go through all the same training, and you know, they might as well be licensed, but they have to go through, and they don't receive referral credit, but they do get it into their RMIP, their scorecard. They get the revenue credit into their scorecard. But the licensed ones do get secondary referral credit. They'll get 10% of the sale, the revenue out of the sale. But you know, by and large, we really, if you're going to become a private banker, you need to be fully licensed.
Mm-hmm.
Mm-hmm.
Yeah,
well,
I was
consistency, Mike.
Yeah, I mean, I was a little disappointed that only 10% on that last slide are really fully licensed. You know, I think that's maybe an objective that we should work towards within our respective banks, because, you know, until they're fully licensed, can individuals really, you know, can we say that that individual really is engaged in that role? And can we say that the bank is engaged in that role if it's optional? I mean, where else in the bank do we have employees that are responsible for some type of function or task, but only 10% of them are fully qualified with all the licensing and training in order to be able to do that task? You know, where else? In mortgage, commercial, or there's nowhere else. So until we can really solve that, I think we run the challenge of not getting full engagement from those employees, you know, from fully getting their engagement, because it's just not on their short list of responsibilities. And, maybe that leads to this question for the group here is, how about reporting lines? Do you think that has any influence on this? I mean, the retail investment area is different in different banks and has gone back and forth between, should it be part of wealth? Should it be part of retail? And, if retail's providing these private banking referrals or these premier banking referrals, does it make sense to align with that group? Because you might, show up on the same income statement and get better referral support, or is it better to be aligned with the wealth area because the personal trust folks look more like our investment folks? Does that have any say in how we interface with these, referral areas within the bank? And I'd like to put that question out there to get some thoughts on it.
Yeah, Peter, you kind of took the words right out of my mouth. I was going to say reporting lines might have a lot to do with it because, private bankers have investment management that they can sell through a portfolio manager and through a private bank advisor. So it's not necessarily their priority to find investment opportunities for a licensed advisor because they have the ability to refer over to somebody in the personal trust side. So I think that has a lot to do with it. And I think those that are typically licensed are licensed because at some point in their former life they needed to be licensed. It's not necessarily that they got licensed for the purpose of being aligned to an advisor. So I think that this organizational structure does have a lot to do with it.
Okay, good, thanks.
I would agree with that. I think that is a big issue about where something goes, and organizational structure is absolutely a big part of it.
Any others that have seen positive or negative because of those changes, or on the, not on the screen, but on the phone? Any others want to chip in on their thoughts on it? Because if that's a driver, that we've got to find the things that drive this new model, and referrals are most likely going to be harder to come by. I mean, they've flattened out the last couple years based on our data, both in banks and credit unions. They flattened out. You can bet when 2020 data comes in, referrals will be down. Do they rebound to where they were, in 2021? Do they rebound to where they were 2 years ago? I don't know. I think we've got to do more with the referrals that we get and the business channels that we've established, and view these referrals more valuably than we have in the past, because there's going to be, it's going to be scarcity of them.
I would also point out, which could be an advantage as far as trying to move in this direction, because we certainly are having conversations about this, but obviously with rates being this low, it's a lot harder to make any money off of spreads on deposits and so forth. And then also loans. I mean, certainly you're getting loans, but the spreads are not there. And so that's another issue. And I think every firm out there is looking for ways to generate fee income. And so I think that's another factor that's going to come into play in this, because it looks like we may be in this situation for a while.
Mm-hmm. Good point.
Yeah, we're looking at changing compensation plans for the private bankers a little bit to more emphasize referrals to wealth and less the loans and less the deposits, just because of the environment that we're currently in. So we're looking to do that for 2021.
So what are you going to do there, Harold? You're going to...
So in their scorecard, we're going to de-emphasize the loan side and de-emphasize the deposit side, and put
the
greater
weightings
emphasis.
of how much those are valued?
Yeah, and greater emphasis on the investment side and the
Nice.
revenue generated from the investment side.
Of course, that's a tactical short-run solution. It doesn't go to the fundamentals of creating a team between a banker and an advisor. Help in the short run, but won't necessarily take root. Peter, you know a lot more about the Merrill Edge program than I do, but isn't that a pairing of a banker and a broker?
It is, and it's really tying one client relationship with a banker and an advisor. But the Merrill advisor is the point person.
Mm-hmm.
That's the difference between the Merrill Edge and I think a lot of other programs is that that advisor is the point person for that client's relationship with the branch. Now, when they need banking services, he or she gets them to the right person in the branch. They book those deposits or they get the loan written. When they need investment services, that person, can handle that for them. But it's the assignment of the point person as a primary investment person versus traditionally the branch has had that primary assignment of the point person as the private banker or a bank skill. And the Merrill Edge program has changed it to where that skill is an investment skill. And that's been a very successful program for B of A and for Merrill. And so much so they're thinking about changing it. It had to be successful if they're thinking about changing it. So just by that, the sheer proof of how successful it's been, I just saw in the last week it's going to be changed. So
yeah, are the bankers registered?
The bankers are not registered because
Okay.
the Merrill Edge person does the investment business.
Okay. Mm-hmm.
Yep. And that's for client. Now it's a little bit different target than what we talked about here. I mean, that tends to be for under $250,000.
Yeah. Mm-hmm.
So it's a little bit different target than, the private or the premier bankers, but it's the fact that they're making it a solution that encompasses investments, but not at the expense of deposits. The deposit side and the loan side is much more valuable to the bank and pays more to the Merrill Edge person, the deposits and loans do than the investment business on a relative basis. So, even though that person is primarily an investment person, I would say they would earn more, at least equal, because of their loan and deposit work. There's just more money in spreads to, divide up.
Mm-hmm. But we do have another question coming in over the chat line. This one's from Richard Feder from Fort Lee Savings and Loan in New Jersey. He says, why does this have to be two different people? Why can't one person be a broker and a banker?
Any thoughts, anyone on it? I mean,
Yeah.
Mike, you look like you've got something to say.
Yeah, I would comment that one of the challenges, at least that we have, is we actually customize way too many loans. And so because of that, we don't have actually packaged loans. We actually are looking at a system right now. The other thing is there's this view that, obviously credit trained people, it's important. But it's a circumstance where the question is are you going to have the lender essentially become a broker or a broker become a lender? I mean, it's really kind of a complicated decision. It would be more efficient in a lot of cases. But at the same time, unless you're talking about just a very simple packaged loan, I think it's hard to have the FC do that. Now, I will say you're starting to see Morgan Stanley, Merrill Lynch, a lot of them starting to do a lot more loans, but those are across systems typically that have basically packaged loans. So they do have a system to do that. So I think that's where the issues are. I'm curious if anybody else has come up with a solution for that, because it is a good point.
Well, definitely firms from a deposit side, you look at the competition now for deposits and every online brokerage firm or brokerage firm all has check writing. Many are paying better rates than what, a local bank will pay. I think the competition for deposits and, a single source delivery point for deposits that's there because it's simple. It's not as complicated as a loan. And certainly everyone wants them and everyone offers them. Schwab and TD and Ally Bank and, all those have great online rates, and, that takes no skill to do that. So I think it's the loan that makes it, the loan and investment disciplines are hard to marry together. The deposit can go either way.
Yeah, but I think the issue with deposits, and maybe not so much right at this moment, but there is also the risk of cannibalizing deposits, that the bank is looking on balance sheet. So, you have to have a system that you have the ability to put, deposits on the balance sheet, and frankly move them on and move them off, which we do have. It's not perfect, but it's somewhat effective. But that's the challenge with deposits, is that it's constantly evolving, where they want deposits certain times and other times they don't want them. So,
but it seems like, talking about the complexity of loans, that there's an analogy of that with the investment advisor. The investment advisor, I'd be surprised if many investment advisors really understand Black-Scholes and so on. But they certainly know how to deal with packaged products and advisory products with their other money managers doing it. So they're really essentially dealing with the lower to middle tier of investment technology, if you will. And similarly, they could deal with that lower to middle tier of lending, and where there could be specialists who would deal with the complexities of tailoring a loan for a particular client, and so on. So I think that there's, I don't buy the idea that the advisor couldn't master a lot of those things, just like they don't master all aspects of investment advice. But they're a gateway to that font of knowledge that the industry has, and they can get you that advice.
Yeah, I would point out that SoFi and when you look at Quicken Loans and so forth, they figured out how to create this platform where you put in your information, and if you fall into certain qualifications, there's nobody's touching it. And so, it's a circumstance where that is the competition going forward. And so, and right now I think a lot of firms are looking for the more complex loans, but I would say a large number of the loans fall into those categories where they are loans that could be packaged. Quicken, SoFi, there's a lot of companies out there that have created these platforms.
So what have we seen from a partnering perspective that has worked between the advisor, private banker roles? I mean, what is our, what's the go-to model right now, or what's the go-to method that enables those roles, in any of your all opinions, to work when it does? Is it coverage? Is it coverage that, there's one advisor to one private banker, they know each other, they know each other's business, is it something like that? Is it the skills that they have? Is it how they're paid? What do you think if you're able to build that program today, how would you build the interaction between the advisor and private or premier banker?
I think it's really the skill set and the quality of the people you have. I don't think it's necessarily ratios of 1-to-1 or 2-to-1 or whatever, but it's really just the people's ability to get along together and partner well together and like each other. So, we've got advisors that one advisor might cover 3 or 4 private client RMs, or we also have one where, one advisor might just work with one and get very good level of referrals, but they really know each other. And the PCRM, private client RM, has a lot of confidence in referring business to that person because they trust and like everything that they do and how they treat their customers. So I really think it's more just the people involved in it.
Yeah. So Harold, in that model, should the advisor be part of the hiring decision for the PCM, I guess is the role that you have? Or should the PCM be part of the hiring decision for the advisor, or partnering decision, let's say?
Yeah, so we don't assign partnerships. We have what we call open architect. which is a fancy word for just anybody can work with anybody they want to. And it really just comes down to who gets along with who, you know, and that's where we've been doing this now for about 6 or 7 years, and we're finding that it really just, people that work well together stay together. People that don't work well together kind of keep floating around trying to find somebody that worked well with them.
Any others on that? Because Harold, I would say that's, most banks are more prescriptive in those relationships than that. Agreed from panelists? Or
I've seen a couple of these models work pretty well. I think and just so I've been a financial advisor for 22 years. So in the field, we did a significant amount of life as well as investment and annuity business over the years, and having outlets, especially for high net worth or emerging net worth or mass affluent, they kind of expect that there's going to be specialists. So to the prior question a few minutes ago about having, you know, one person do it all, I don't believe anybody really believes that there's one person who's great at everything, especially if they might be transient and not here in 2 or 3 years if they're thinking at the bank level, which unfortunately we have a high turnover in the industry. I think relative to your question, Peter, and to comment on what Harold said, I think that process is really critical. And I would even go so far to say that if a bank wants to acquire more assets and deposits at the same time and be viewed as potentially a financial resource of advocacy, right? And this is moving towards this, and we are an institution that provides advice the way that Merrill Edge has done with their convenient apps and their scale. In order to do that, it's actually going to take it's going to take almost a mission-driven change. So that at the bank level, we are advocates for our customers, and we've built out the resources of planning premier private level banking, and it's understood throughout the entire organization that we collaborate with client data holistically. So if we're going to do a plan, we're going to do a Money Guide Pro plan for our client, that goes through the system and everybody is aware of that household to become an advocate for the greater household. That's very sticky and gathers an extraordinary amount of wallet share and deposits if you can pull it off. But it does require almost a mindset shift that from the top, we are going to be advocates for our clients, not just on deposit, on demand with great customer service. We're financial advocates. That's kind of, that's a change, the shift I think we need to see, not just can we change incentive alignments, can we hire the right people? We need to have that process and purpose down pat so that the customer knows why they want to work with us as a bank.
Yeah, well said. Okay.
And of course, a lot of banks say that's what they do, right? And we don't see it, right?
Well, we're going to change that today, right? That's our plan today. We're going to change it.
Right.
Well, and some of those challenges are, you know, it's this age-old spread revenue of 325 basis points, you know, versus 125 basis points for investment assets. I mean, that's what we have to fight against. And, you know, so we have to win on volume. I mean, you know, we're not going to earn 3 every year. And even if theirs come down, they're not going to come down to, you know, 125 basis points. So we have to win on volume of getting a bigger share of that client's wallet. And that's why this process is so important, you know, of how we interface with these referral sources, is because we're not getting all the dollars today. If we can get all the dollars, then on an absolute basis, you know, it may not be 325 basis points, but it's equivalent revenue of 325 basis points because we captured more assets. And wherever those assets go, then we win. And that's where I think we've got to keep coming back to, is that, you know, it's the advice and it's the value that we provide by, you know, categorizing what they have, where they have it, give them direction on it, and then give them the right products to meet the direction that we've provided them. And that's our process. But that's what the referral sources have to facilitate that. And the question is, you know, where do they start and where do they end? You know, do they profile? Are they engaged? You know, some extent, do they do the whole process? You know, where do you draw the line and bring the expert in? And I think that's what you all are, you know, at various different stages of, is within your organization. You know, where does the advisor start, and where does the referral source licensed banker, licensed private banker end.
Yeah, this is it's sort of reminiscent for me, I think, of some conversations that we've had, at previous roundtables, right, Ken and Peter, about integration of wealth and brokerage. And, you sort of think about all of the different resources within the bank, or all of the different specialists within the bank. And it's like there's always agreement that these people need to play along with each other, in order to deepen penetration. But a lot of it seems to come down to who plays that quarterback role. Earlier today, I forget who it was, but someone sort of declared, right, that, well, the benefit of one benefit of having a licensed branch person is that they're going to quarterback the relationship. Well, should the licensed branch person be the quarterback? Should it be a financial advisor? It seems like a lot of the conversation is maybe kind of swirling around that.
Mm-hmm.
Yeah, a lot of times it's, you let the customer decide, right? Because they'll tell you what's most important to them. And oftentimes it does end up being the investments, right? Because that's their serious money. But it may very well start with the banker, but as the relationship evolves and as it deepens, oftentimes you do find that the advisor kind of takes the lead, just because they're having the most emotional interactions and deepest discovery with the client based on the nature of the relationship they have with them.
Mm-hmm. Well, let's turn the conversation around a bit. So far, we've been talking about, in terms of partnership, is what can they do for us, right? How are you going to give us the referrals we need to provide better investment advice, and of course make more money for the firm and us and so on. But we shouldn't neglect how important advisors can be to contribute to what the bank really wants, which is more deposits and more loans. And we're accumulating more evidence of that. But one discouraging thing is that even though a lot of the firms say that they are encouraging, or even in some cases incenting, advisors to refer business to the bank, what we found in our research is that hardly anybody tracks what the outcomes are. I mean, what's the dollars that, in fact, the advisor force has provided? Well, what are the net new deposit dollars that the advisors are responsible for? I guess, Mike, you got caught in a trap of having to. Once you start measuring that, they want you to do twice as much, right? Mike Marabali.
I always have trouble with the unmuting. Yeah, I mean, thanks to your study last year, we started putting that front and center, and we run two P&Ls, one with the investments and one with the deposits, and we actually maintain our balance, our deposit balances alongside the investment revenue, and we create like a fee share. Now it's not real, it's funny money, it's not real money, but it helps us then be able to portray the true value of the business to the bank. Because once you add up the spread revenue off of those deposits and you combine it with all of the other revenue that's compensable and has expense tied to it, the profitability of the business, or the contribution to the bank, looks very different. So it makes, and then to your point, it makes the bank want to see more of that, and then you're kind of on the hook, and you become one of the resources to be able to drive more deposits, and it goes from, hey, that's really great, you guys are wonderful, to it's an expectation. So, but I'd rather have that than than having it essentially ignored. So it does certainly help, I think, plead the case of the value of the investment business to the bank.
Mm-hmm. Yeah, and we're trying to dig a little deeper into those those ideas and driving off of the idea of maybe investment services is one of the cheapest ways you can get new deposits. And the people upstairs at the bank tend to sniff at the little bit of contribution of income that investment services provides, but they actually pay up a lot to get deposits. And so in fact, it may be that our preliminary insight is that this is a very inexpensive way. You're making money, not a lot. You're making money while you're driving deposits.
Right.
So on a net basis, it's pretty impressive.
Yeah. And in an era with, virtually zero branch traffic, you've got to think, right? People are calling their advisors right now because they're worried about what's happening to their, to those funds, right? Are they calling around looking, are they shopping rates for their deposits at, to the same extent, with the same fervor? I doubt it. So, you'd think that right now, your advisors are having a lot more contact with the bank's customers than maybe than the bankers are.
Mm-hmm. Mm-hmm.
Or someone is.
Oh, sorry.
Or someone's having contact with them.
That's right.
That isn't within your bank or investment area, but someone is, because the clients are demanding it.
Yeah, and there's an enormous amount of cash on the sidelines, as people may be aware. And unfortunately, to some degree, a lot of that is actually in the brokerage and wirehouses where they're earning nothing, and that's where they're making their money on the spread. So actually, there's a huge opportunity to bring cash back to the bank and deposits. If we went out and grabbed some of those investment management dollars that are just idle and sitting in cash and may wind up staying there for years just because clients are scared. Especially the older populations that are looking for income sources, and they're worried about outliving their assets, maybe staying at work a little longer now if they have jobs. I think there's a huge opportunity, but I think again, and I kind of, I know that Will has some great metrics on this. People that can finally get engaged on the financial planning side, they acquire more assets, they're more sticky. So the question is for, I think, a lot of us is how do we create user experience that both creates a magnetism for new assets, and we didn't really talk too much about insurance, but I think there's going to be a massive interest in insurance, and I'm not sure that the general consumer base knows that banks can provide this outlet natively unless we go tell them. So we have to tell them, and that's the job I think a lot of banks really need to invest in, is telling people they can create an outlet for advocacy and guidance and experiences and get stuff done that's not just about deposits. So that's how I will finish my piece.
Sum it up, yeah.
Seems like we're starting to wind down on the time. Any other insights before we close?
Ken, if I may, just real quickly, I would say, just kind of to piggyback on what Adam was just saying, as far as opportunities go, we can tell you that a lot of our firms right now, I don't know if the folks who are on today have a hand in this stuff, but a lot of our firms are down right now since COVID started on their plan output, which is a little bit surprising because you'd think folks right now would need that insight, especially in a volatile situation. And the blocks tools that we're coming out with currently are meant to help advisors in kind of the exact situation we've talked about today, where, for example, we've got one that's meant to look at spending versus borrowing. So if you've already deepened the relationship to the point where you have an investor and advisor who are doing a plan together and they want to purchase something, they can work within a tool that tells them, hey, this is a good time to pull money out of our assets, or should we go get a loan from the bank? And if the answer is loan, a lot of times it will be, you've got tools that both the banker and the advisor can use together and just make that handoff right there. So one, like go update your plans. I don't know if, again, if you can make that push for it in your positions, but do it. There's a huge amount of opportunity there. And then use the tools you've got, Asset Map, Money Guide, blocks, use them to bridge between the banker and the advisor.
Mhm. I think we should once again thank our sponsors, Asset Map, Investment Money Guide, Pacific Life, and the Standard, and for sponsoring this event, and thanks to our friends at Salmon's Retirement Solutions for bringing this all together for us. And particularly thanks to all of you who spent the shank of the afternoon with us and listening to our ramblings about the different ways of partnering with bankers. We hope you'll join us for our upcoming meetings. We have 2 more virtual roundtables in our usual fall leadership roundtable event. The next one will be October 27th, where we're going to try to focus on the information you need to get ready for 2021. And then on December 3rd, we'll be discussing the integrating digital advice with your advisors. But we have other events coming up as well. Next week, we're introducing our Planning Insights, our new benchmarking tool to look at on an advisor level, comparing your advisors with thousands of other advisors and how about the quantity and quality of the planning they do. And then we're going to revisit our call center survey and discuss the call center delivery of financial advice in December. We hope you'll join us at one of those meetings, one or more. But again, thank you for participating in this one, and you'll see us again soon. Thanks.
Thank you all.
Everybody, take care.
Bye.